Jaguar Back to the Future. Seriously? You've never watched that movie? Never heard of that expression? That was supposed to be fun, right? Yeah, we're off to a bad start today. Okay, so we talked about different methods of calculating inventory, both ending inventory and the cost of goods sold. And as you remember, we said that the goods available for sale, which can be calculated by adding the purchases to the beginning inventory level, so beginning inventory plus the purchases will give you the cost of goods available for sale. So this will give you cost of goods available for sale, right? This is basically what the company could have sold during that period. Okay? So, we learned about LIFO and average cost. We also learned about a fourth method. We said that it was actually the most accurate. What did we call it? Sorry? No, it's not the most accurate. Yes. Specific identification. This is where you actually have the product serial number. So in this case, you know exactly how much each TV you sold, the cost basically of each TV that you sold. Okay? So we have the specific identification. When this is not possible or if the company is not using that, they will be using one of the cost flow assumptions. And why do we, again, as a reminder, why do we call it cost flow assumption? Because this is where we are making an assumption that the goods are being sold in a certain order. So FIFO, we're making the assumption that the first products the company purchased will be sold first. So this is why first in, first out, right? LIFO is last in, first out. So we're making the assumption that the latest purchases will be sold first. Okay? And we learned also that the way usually companies do that is they, at the end of the year or at the end of the month, if they are doing that monthly, basically say that at the end of the year the company would run an inventory count. They physically count and weigh each item they have. That would give them what? What does it give you? Ending inventory. That's the inventory balance at the end of the year. You counted them, and this is what they told. This is what you found that you have. Based on that information, this is subtracted from the cost of goods available for sale. The difference between the two will be the cost of goods sold. So basically, the cost of goods available for sale. This is whatever the company could have sold. They sold part of it, and the remaining, or the ending, that would be the ending inventory. This is whatever inventory remained in the warehouses. Okay? I'm just repeating what we said that last time, just as a reminder. Friday was way in the past. So you probably forgot everything about it, especially after partying, most likely over the weekends. You get like formatted. In nerd terms, your brains are formatted. So I have to repeat that. Not happy about it. Especially that you're not laughing at my jokes. I mean, come on. But in this case, while we know exactly how many units, the company would know exactly how many units they have, they still need to allocate the cost of each unit. This is where FIFO, LIFO, average cost, etc. come into play. In this case, when we have the cost of goods sold, so the goods are sold on first in, first out basis on FIFO. When the company is using FIFO, what's happening? This is what we're saying that. So let me remove. Okay, I cannot remove this. Anyways, so basically, the first ones will be sold first. So you will be selling this one first, this one, etc. The ones that will remain until the end will be the ending inventory. Will be the latest one. Will be this one, and then part of this one. In this example, as you remember, we said that we had 450 units that were remaining. Those 450 units remaining, that's the ending inventory. Because we're doing FIFO, the first ends will be sold first. So which ones will remain? The latest ones will remain first. Will remain until the end, so, right? So the first ones are being sold. The latest will remain until the end. This is why when we calculate the ending inventory, we start from the latest ones and we go backwards. So the latest one, those are the ones that for sure will remain until the end under FIFO because you're selling the first ones. Okay? So you start with this one. This is not clear. Here we needed to use 50. Remember it was 400 and then 50. So the ones that will remain will be the 400 and then the 50 from the previous one. Why is that? If you look at it on the other side, from the other side of this, basically, if you look at it from the cost of goods sold, we sold 550 units. Where did we get the 550 units from? Lauren, go ahead. After you count your ending inventory, you have a total of the cost of basically the goods available for sale. The number of units that the company could have sold were 1,000. So the 550 is actually 1,000 units available for sale minus ending inventory. That's how we get 550. Okay? And again, if you want to calculate the cost of goods sold directly, you start with this one, so those are sold first. Those are sold next. And then 250 from these will be sold after that. The ones that will remain will be 50 from this batch, this 50 here, and the 400 after that. So this is our ending inventory. Any questions? Okay. LIFO will be the other way around. With LIFO, we are actually selling. So the cost of goods sold will be from this one. It's the latest ones will be sold first. And you go backward. So this one was sold because we sold 550. And 150 from this one. And from this one here, we have 150. That's the same 150 here. Those 150 were sold. The remaining ones will be, those are the ones that will remain until the end. Because you are selling the latest ones, you will reach the earliest purchases last, right? So those ones will remain until the end. So those are the last ones to be sold. The last ones to be sold will be your ending inventory. So your ending inventory will be this one, and I think 150 from this one. Those are the ones that will remain in your warehouse. Once again, when you are asked to calculate the cost of goods sold, how do you do that? You calculate ending inventory and you subtract that amount from so if you are to calculate the cost of goods sold, you subtract, what do? You calculate ending inventory and you subtract that amount from Cost of goods available for sale. That's the cost of goods available for sale is whatever the company had. All the TVs that the company had over that year. Okay? They sold part of it. It's the same thing. If you say they sold part of it, let's say they sold 80%, they still have 20%. If you say that they still have in their warehouse 20%, that automatically means that they sold the remaining one. They sold the 80%. Okay? It's same thing. The only thing that is changing here is basically how you allocate it. So the total amount between the total amount of ending inventory and cost of goods sold will always be the same amount. It's simply the composition of what's considered as cost of goods sold and what's considered as ending inventory will be different. Now, the average cost, we said that this is a weighted average. Basically, you calculate the total cost of goods that you have in your warehouse. This is the cost of goods available for sale. In our example, it was 12,000, and we divide that by the total number of units available for sale. What you're saying here is that, okay, so over the past year, we had 1,000 TVs, 1,000 units, and the cost of these 1,000 units were the total cost of these 1,000 units were $12,000. So the total cost was $12,000. On average, it is $12 per unit. That's how we calculate it. As you remember, how did you get to this number? Do you guys know how we got to this number? You multiply 100 by 10, 200 by 11, 300 units by 12 units, and 400 units by 13. Those will give this amount, and then we sum them up. This is the sum of all these costs of each batch. This is basically how much you paid. You paid for the first 100 units, you paid $10 per unit. For the second one, which were like 200 units, you paid $11. For the third one, 300 units, you paid for each one $12. Sorry. As a total, you have $12,000. And how many units? 1,000 units. You divide this one by this one. That will give you the average cost per unit. Now to calculate ending inventory, multiply that by the remaining inventory, by the ending inventory. You still have on hand 450 items or 450 units. Multiply it by 12. Cost of goods sold, you know that you sold 550 units. Multiply it by 12. Another way to do it again is to do the same thing as before. You can also subtract this number from the cost of goods available for sale. Any questions? Okay, so this is just a review of what we did last Friday. Now we are back to the future. Oh, come on, again? You're impossible. Okay. Did we do this one? No, this one, that's all. Just so that you would get the smiley face, right? Okay, so the cost flow method. The atomic barrier is the actual physical flow of merchandise. Is called what? Okay, so that. Are you guys done? 5 more seconds. So I'll give you the first 5 for free. The next one will be, you will have to pay for that. Doesn't matter.
Oh my god, I can't believe you didn't get a smiley face.
No, you're not. No, I can't believe it either. That you did not get the smiley face on this one. Sorry, but you did not earn this one. Now this is an example of what you might be asked in the exam. Okay? Or in the homework. Could be a little bit more complicated, but this is the same concept. One thing you need to remember, if you can solve this question, for example, at home, and it takes you 10 minutes, that's not good. You cannot say that later on, I know how to solve it. You need to know how to solve it within the same time that you would have in the exam, which is usually like 2 minutes, on average, 2 minutes per question. That's the trick, that's the hardest part. Yeah, at least we got what looks like stairs, but I'm not saying that that was a good thing. I'd rather have one answer. How do we solve this one? Whenever you have the question, yes?
Last in, first out, so you basically go for the first one on the list.
Exactly. So this is LIFO. LIFO, what does it mean? It means that this is, you are selling the latest purchases first. In other words, the earliest purchases will remain until the end. So for them to calculate ending inventory, they are asking you for the value of ending inventory. You start from the earliest ones first, right? So in this case, you need, how many remain? 180 units. It's very simple. Under LIFO, it will be 180. You can take them all from which batch? The first one. So it will be 180 multiplied by 5. That's equal to 900. So that's the correct answer. If we were to calculate it under FIFO, how would you do that? Under FIFO. Perfect. Exactly. So if we were to use FIFO, guys, it's coming up. So if we were to use FIFO, we would start from the end and we go backwards, right? Am I correct? So in this case, it would be 150 multiplied by 5.5 plus, how many do we still need? 13 multiplied by 5.3. Okay? Let's do a second one. Let's see if we'll get one answer or it will get another set, basically some stairs, something else. I don't know. Solve it in the same way.
Ooh, I got it.
Does this mean you got the first one wrong?
No, I got the first one right too.
Okay, good.
So the first one took me a little while.
Now you know how to solve it. That's that.
I read the question wrong the first time.
See, when you practice this kind of questions, those are simple questions, but if you don't practice them well, what will happen is that in the exam you will get all mixed up between LIFO, FIFO, etc., especially under the stress of the exam. If you learn how to do that, when you have a question like that in the exam, it will be like, it will take you like 10, 15 seconds to calculate, which is always an advantage because you can use that time to solve a second problem that might be more difficult or something like that. You guys need more time or is it good? Okay. Okay, still better. I'll give you a smiley face. Just to basically encourage you to do better next time. So in this case, they are asking us to calculate the inventory on December 31st. Okay? This is the same thing as ending inventory. They are asking you to calculate ending inventory. And it shows that they still have 8,000 units on hand. Okay? This is using FIFO. So under FIFO, you are selling the first ones first. Earliest purchases are sold first. As a result, the ending inventory will be from this one first. You start with the latest. So for ending inventory, you start from here and you go backwards. We have 8,000 units. So we take 6,000 from this one, multiplied by 7, plus, how many do we still need? 2,000, right? We still have 2,000 from the previous one, multiplied by 8. Now, it could be also that the question might ask you to calculate the cost of goods sold instead of asking you for the ending inventory. How do you calculate that? Lauren. Exactly. So this one will be 58,000, right? This is the ending inventory. First, you need to calculate the cost of goods available for sale. The cost of goods available minus ending inventory will be equal to cost of goods sold. We know that this one is 58,000. What about the cost of goods available? That's the easiest part. It's always the same thing. You have 10,000. To calculate this one, you have 10,000. This is 10,000 units multiplied by 9. Plus 9,000 multiplied by 8. Plus 6,000 multiplied by 7. That's the cost of goods available. From this number, you subtract 58,000, and this will give you the cost of goods sold. Any questions? The same thing could have been asked from the previous exam, from the previous question. And this one here also, it could have been asked to calculate the cost of goods sold. Okay? The same thing. You calculate the cost of goods available for sale, subtract ending inventory. It's always the same thing. Let's do this one now. Here first, they are asking you to calculate the average cost per unit. star. See? You got smiley face and a star. Okay, I did not need to make it this weird. That's better. Hey, take it or leave it. So again, when they ask you, sometimes they don't ask you to calculate the unit cost. They will ask you again for the cost of goods sold, or they will directly ask you for the ending inventory. You always need to calculate the cost per unit, the average cost per unit. It's very simple. Calculate the cost of goods available divided by total units available. Okay? So in this case, cost of goods available for sale will be equal to 200 multiplied by 10 plus 300 multiplied by 12. You divide that by 200 plus 300. And I know I could have written 500. The reason I'm leaving it this way so that you can see where this calculation came from. Okay? That will give you the average per unit. Now, if you are asked, if you are told that the company sold 250 units that year, how do you calculate the cost of goods sold? Multiply it. 1, 2, right? Okay. So, you multiply 250 by the average cost per unit. That will give you cost of goods sold. Any questions? Those are the 3 methods of inventory that sometimes students mess up big time in the exam. You shouldn't. Concepts are very simple. Try to understand them. Once you solve a couple of problems, you will actually know the material and know what to expect or what kind of questions might be asked. Now there are different reasons why companies might pick one method over the other. You see, those 3 methods are acceptable under GAAP. But which one would the company pick? Each method is basically bringing up different numbers in both cost of goods sold and ending inventory. If you look at those examples here, we always had 12,000 here, right? For all methods. So the cost of goods available for sale is always the same, it does not change. And why is that? This is the amount of money that the company paid in total for everything they bought. They know exactly how much they paid. Now what makes it harder is when they allocate the cost to sales. If the company sold 100% of their products, cost of goods sold would be easy. Why is that? Cost of goods sold will be equal to 12,000 in this case. Because they sold everything they had. Their ending inventory is 0. The problem is that companies, they don't sell everything they have. They have ending inventory. As you can see, ending inventory under the average cost ended up with 5,400. And the cost of goods sold under average cost, it was 6,600. Under LIFO, I believe it was 5,000 and 7,000. So the 12,000 will always be the same. What will change is the composition of those 12,000. Okay? How much will go to cost of goods sold, and what is the remaining part that will go to the ending inventory? So companies might pick one method over the other for different reasons. One reason is the income statement effect. The other reason is the balance sheet effect. Third one will be tax effect. Okay? What do we mean by income statement effect? Why would net income be affected by how much ending inventory you still have? by which method of inventory you have. Because remember, inventory will go on which statement? Balance sheet. So it will go on the balance sheet. But why then, why is net income affected? Yes?
The ending
Yes.
inventory will be different.
Any inventory will be different, but any inventory will be where? On the balance sheet. So why? But there's the other side of the ending inventory. What's the other part of it? Lauren? The cost of goods sold, which is what? It's an expense. Given that the expense is affected by which method the company is using, that will affect that income, right? So when you had cost of goods sold 7,000, you had more expenses. You have more expenses. What does it mean? Well, as far as net income is concerned, you have less net income. So you have more expenses. Your net income will decrease. So if you pick the method that would end up with the highest cost of goods sold, you will be decreasing your net income. And if you pick the one that ends up with the lowest cost of goods sold, it will increase your income. Okay? So we'll look at each one of these reasons separately. This is the example that we had. As you can see, cost of goods available for sale is always the same. This does not change. What will change is those two together, those two. Ending inventory and cost of goods sold. Those two together. Take a look at this table. As you can see here, when you had the lowest cost of goods sold, you have the highest net income. This is usually the case when, basically, FIFO would always give the highest net income in periods where we have inflation, when the prices are going up, because you will be taking into consideration or including in the cost of goods sold the earliest purchases, first in, first out. The earliest purchases will be cheaper. This is when, like, if you talk about TV1 was purchased for $500, TV2 was purchased for $550, TV3 or $600. When you pick the earliest ones, they are cheaper. So in periods of inflation, FIFO will lead to the highest net income because cost of goods sold will be the lowest. They are recognizing, or they are taking the cost of the earliest purchases, which are cheaper in periods of inflation. LIFO will do the other thing. It's the other way around. LIFO will decrease net income. And as you can see, most of the time, we live in an inflation period. So basically every year, prices go up. They rarely go down. Okay? Now when they go up, what happens is that you have most companies, if you remember from the graph that we had, most companies, they pay FIFO. Because companies, they have interest in increasing their net income for many reasons. Why would a company try to increase their net income? Give me an example. Why would management of company pick FIFO to increase their net income? So more people invest in companies, basically to make it more appealing for investors. This company is profitable, makes more money, so they want to attract additional investors. Can you give me another example? Lauren. The management themselves, some of the management board, you mean like the CEO, etc. Usually, companies' management is, in many cases, they have a compensation linked to company's performance. So basically, the better the net income, the higher the management's compensation. So they want also to make more money. They pick the method that will lead to the highest net income. Again, this is not always the case. It's not always that FIFO will lead to a higher net income. If it was a period where the prices are going down, FIFO will give the lowest. Just think about it this way. Which one will lead to the highest cost of goods sold? The higher the cost of goods sold, the higher the expenses. The more expenses you have, the less net income you have. Okay? Just think about it logically. questions. So this is why companies might take, for example, this is what we call the income statement effect. It's how the change, basically how the change in the method, the cost flow assumption method, basically changes expenses and net income. The other thing would be the balance sheet. Now we're talking about inventory, right? This is basically to say how much inventory you have. There's one thing that I wanted to mention with this one, with the income statement. Some people argue that LIFO would give, in periods of inflation, LIFO would give a more accurate profit. Okay? The reason for doing that is that what's the cost if the prices are going up? The cost of replacing the inventory that you have will be closest to the latest purchases, right? Because the prices are going up. So if you want to go and buy a TV now, let's say that you had, again, TV 1, 500, 2, 550, 600, 650, etc. If you are going to buy, to basically you sold this one, you want to replace it. So the replacement will be closest to which one? To the bottom one, right? To 650. As a result, the difference between whatever you allocated under FIFO and the difference between net and what you can actually, basically the price, the replacement cost of that item will be taken from this net income. So this is why sometimes they call it like ghost profit or illusionary profit. This is not a real profit, because if you are going to replace the inventory, you will still have to take money from that income, because now it costs more. Okay? So they say that some people argue that LIFO actually provides a better or more accurate income, because again, they argue that. So there isn't like some kind of everyone agrees on this one. It's not always the case. So sometimes this LIFO provides a better estimate, because the latest purchases, so the ending inventory, the value in ending inventory will actually be the closest to, basically, the cost of goods sold will be actually closest to whatever the company will pay now to replace them. On the other hand, FIFO will provide you with the best estimate for inventory. Why? Which ones will remain until the end? The 650, which is the closest to what the company would have to pay now to replace or to replenish their inventory, right? So their ending inventory would be the most accurate. This is why all three methods are acceptable, because there isn't like one method that is always superior to the others. The balance sheet effect, again, this is what we just mentioned, that FIFO would actually leave as ending inventory. The ending inventory will always be, the closest to the actual value that the company, to the actual cost the company would have to pay to acquire new, or basically to replenish or replace their inventory, their sold inventory. Okay? LIFO, on the other hand, might have, because they are selling the latest ones, they have the earliest, basically, which is the oldest inventory that is still in the ending inventory. Okay? Like for example, I think the book gives the example of Caterpillar. They use LIFO. Their ending inventory's value is like $14.5 billion. That's the ending inventory. If they were to use FIFO, their ending inventory, basically their ending inventory will be like $16.9 billion. So there's like $2.5 billion difference between LIFO and FIFO. companies, they can use whichever they want, but they have to be consistent. And when they make the switch, they have to explain what the effect on income, on the net income would that make. Now, the third basic factor that affects the management's decision is tax, because again, some taxes are paid in cash, right? The IRS will not accept an IOU. The IRS will want to take their money in cash. So when the company pays, when they have higher net income, they will be paying more taxes. Sometimes companies want to keep the tax, so they pick a method that would lower their net income to lower the amount of tax that they need to pay. They still have those assets, so it's the same number eventually. But they will declare a lower net income. As a result, they pay less taxes. Okay? So in a period of inflation, the cost flow method that results in the lowest income taxes is which method? Nope, not gonna happen. Sorry for that. So the cost flow method that results in the lowest income, because in this case, when the prices are in the period of inflation, the prices are going up. Okay, so when the prices are going up, when you are taking the cost of the latest ones, you will be actually taking the highest value of cost of goods sold. You're increasing your cost, basically your cost of goods sold goes up. As a result, your net income will go down. So it will lead to the lowest income, net income. Because it leads to the lowest net income, the company will be paying the lowest income taxes. Okay? And I just switched to the next page without noticing that. But that's fine. This is what we talked about, that the company needs to use them consistently. And when they actually make a change, they will have to make in the notes of the financial statements. What they do is they mention here that, for example, effective July 1st, the company adopted LIFO, etc. The company believes that the use of LIFO method better matches blah, blah, blah. And this is the effect of this change of the current year was to decrease net income by $16 million. They have to mention that how it will affect. And why is that? Imagine that they don't mention this. If you are let's say the investor, and you look at this information and say, okay, last year's net income was, say, $40 million. This year it's $24 million. Why is that? This is a huge drop, right? In this case, what they do is they actually say that it is because of the change in LIFO that we have this effect on net income. At that point, you say that, okay, so it's not that bad. It's not that. Sorry?
What if someone doesn't know that means?
What if someone doesn't?
Yeah, what if the investor's like,
They don't notice it?
yeah, what if the investor's like, don't? And he's like, oh, it went down $16 million.
But they know that eventually, that this money will also be there as assets. So remember,
What if they don't?
you have to think. If they don't know that,
Yeah.
it's in the same way as if you say, what if I don't know the material for the exam? They will be bad investors or they will lose money. They lose like the opportunity of investing in that company. They might be upset and they might just sell the stock. But that company does not mean that they are losing money. So maybe this stock, because when people also, when they will look, you see, this is why it's important to have an income statement and a balance sheet. The balance sheet, they both together, they give you the full story, along with other information. But like income statement will tell you the cost of goods sold, right? The balance sheet will give you what? The ending inventory. So you will see that, okay, while net income increased, our total assets would have increased. Why? Remember that, it's the same thing, the total, so it's like two parts. You have, this is the cost of goods available for sale. This part is ending inventory. This is cost of goods sold. If, for instance, you change this one, you increase your you basically increase your cost of goods sold on this. You increase your cost of goods sold, right? What happens to your ending inventory?
It goes up.
If you increase your cost of goods sold, you are saying that you had more.
The value of your inventory goes up, right?
No, it goes down.
If the goods cost more, then they're worth more. No?
The cost of goods sold, you sold them.
Oh, okay, alright.
Remember, it's two parts. So this one, your inventory will go down. If, on the other hand, your cost of goods sold goes down, your ending inventory will go up. So there's always the two sides of the story. When you talk about lowering net income, it means basically you allocated the cost that was the highest. Okay? We will learn again what happens later on with those. Now, in certain cases, the company might have to walk away from the historical cost principle. This is due to something called the conservatism in accounting. And the conservatism principle basically it asks companies to use the numbers or the methods that would least overstate assets and income and net income. Why is that? Because as an investor, what would be the most misleading to you? If I tell you that this is like, if I give you a higher or overstated net income or an overstated total assets, right? You will think that the company has more assets, or you will think that the company has more assets or more, net income. But that's not the truth. So this is why, in certain cases, the cost of the replacement cost, what we also call sometimes market, so the lower of cost or market, the cost of that product drops tremendously. One of the best examples to give are the IT or like fashion. Those are industries where the value of an item might drop dramatically. Okay? Like in fashion, for example, 2015's dresses or shoes, etc., would be much cheaper in 2016, because that's like last year's models, right? That will be cheaper. As a result, the company is not supposed to keep saying that, okay, they still have the same value of inventory, although it costs them to buy it certain amounts. I'll give you another example, one in my domain where I understand. Let's say that Best Buy still has one of those black and white TVs. You guys, they don't even know what black and white TVs are. They are old TVs that were small in size. They even used to run from the car battery. They didn't need power to run. And the resolution, don't even talk about that. It was black and white, no colors. At the time, let's say a TV would cost, I don't know, $500. Could you still say that this TV will now cost $500? Again, let's talk about a computer that is 3 years old. It was one of the fastest computers and one of the strongest computers, etc. At that time, it would cost like $2,000. Okay? Let's say that the company still have. Are you guys familiar with like Pentium 3 and those ones? Those are old, but at the time they were expensive. Let's say that Best Buy still have a couple of these TVs and they want a couple of these computers and they want to sell them. Can they sell them today for the same price? So the replacement cost, the value in the market is much, much, much lower than what, basically it's much lower than what they actually basically can sell it for. In this case, they can write down the inventory. Basically, they can lower the value of their inventory. So under GAAP, they use what we call LCM, or lower of cost or market. We're not going to go into detail about how to calculate it. In this case, because there are a lot of, it's a little bit more complicated than what we will cover here. You simply need to understand that when you are told that the company is using lower of cost or market, the company would actually look at which value is less. This is basically to try to be more conservative in that they don't want to overstate assets, their assets. They don't want to overstate their inventory. Okay? So in this case, like here for example, you see they have like a very funny, basically sense of humor. So Kentucky TV, and now I'm hungry, but they have the following merchandise, okay? They have flat screen TVs, $60,000. The cost of replacement now is $55,000. Doesn't make any sense. So basically, if you go and you buy it in the market, it will cost you less. If you say that, okay, my inventory is worth $60,000, are you being truthful or are you misleading your investors? You would be misleading your investors. As a result, you have to be a little bit more truthful and more conservative. And the lowest, basically the lower of cost or market, when you use LCM, you pick the lower value. So for the first one, do you pick cost or market? Market. Satellite radios, do you pick the cost or market? Cost. DVD recorders, market. DVDs, market. Okay? Now companies can actually use LCM on item per item or on a category basis. They can also just look at their total assets. So they just look at just the aggregate number, all the assets according to at cost, and all the market, basically, and all the assets at market, basically. So they look at the two values. They can do it, like I mentioned, for each item, or for each category, or for total assets. The important thing is that the company will simply have to pick which one. They have to actually mention in the financial statements which one they are using. So are they using cost of or LCM? They have to disclose that information. So you can see if you look at the, for example, financial statements, you will see that they mention which cost allocation method they use. Did they use, for example, FIFO or LIFO? Are they using cost, lower of cost, basically, or LCM, lower of cost or market, etc. So they mention, and they also need to mention what categories of inventory they have. If you remember, we said that merchandising companies usually have one type of inventory. Manufacturing companies, they might have more than one type. Okay, so they have to disclose all this information. Now, there are sometimes inventory errors. Mistakes happen, right? You're counting inventory and then you miss an item. Okay? Or you count one item twice. Or you simply forget to include goods in transit. So all these are causes of inventory errors. When an inventory error happens, you have to basically fix it, right? Now, when this happens, actually what happens is that it will affect both net income and inventory, right? Because in this case, what is going to affect is going to affect your balance sheet and your income. So the income statement will be affected through cost of goods sold, which also affects net income. On the other hand, the balance sheet will be affected as you basically your inventory. And not just your inventory, something else will be affected on the balance sheet. What is that? Stockholders' equity. Remember that the information from net income, from the income statement, the information will go to retained earnings, right? And then from retained earnings, it will go the balance sheet. So the effect will be carried over to the balance sheet, the stockholders' equity section. Now, there are basically 4 types of errors when it comes to inventory errors. You can either overstate beginning inventory, or you can either have beginning inventory overstated or understated, okay? Or you can have ending inventory overstated or understated. Those are the 4 types of errors that could happen. Now we said that ending inventory, we know that we will count inventory and then we will know that it was overstated or understated. But the beginning inventory, how could that be affected? How could you have the beginning inventory overstated or understated? That was at the beginning of the year. Imran. But you don't count it at the beginning of the year. But you are correct. You missed 1 point. Nah.
It transfers over from the previous cycle.
It transfers over from the previous. So you did count it actually, but last year. So if you count it on December 31st and you overstate your ending inventory on December 31st, 2014, your beginning inventory in 2015 will also be overstated. The error will be carried over to the next period. Okay? And this is what happens. When you have the beginning inventory, when it's understated, so you're saying that, okay, I have less beginning inventory. What will happen to your cost of goods available for sale? It will be okay, let's do that different. When you're saying that you had, let's take another example. So let's look at this example here. The value that you declared last year was $400. So your beginning inventory, you said that, or you thought it was $400. Whereas in reality it was $500. Okay? Those are the purchases. This is the cost of goods. So this is the ending inventory. So this is correct. This one is correct. What happens to your cost of goods sold? What happens to your cost of goods sold? Right. It's understated. Why is that? Again, think about it this way. You said originally that you had 400. Okay? You added the purchases. Let's say that 200 were the purchases. What does that give you? So beginning inventory plus purchases will give you cost of goods available for sale. Right? Subtract from that one ending inventory. In this case, this is not related. So this is another count. This error here was the count from last year. They say that assuming that this year there was no error. Okay, because you're not supposed to make an error every year, right? If you're making the same basically mistake every year, what would happen? You get fired. Basically, you're doing a lousy job. You lousy at your job, so they will get rid of you. So this one is supposed to be correct. This one is supposed to be correct. In this case, what would be the cost of goods sold? Remember that this one, the cost of goods available for sale, it is actually understated. Why is it understated? Because this one was understated. This one you said that it is actually 400, it is 400, whereas in reality it was 500. So you need to add the 100 to it, right? To make it right, what do? You need to add 100. I'm not saying that you will be adding that because now we'll talk about something else. We're simply looking at the effect of inventory. So you add 100, right? You do the same thing to the cost of goods sold, so it's carried over. So this was understated by 100. This one was understated by 100, and this one will also be, the cost of goods sold will also be understated by 100. This is why an understatement, when you have when the beginning inventory is understated, cost of goods sold will also be understated. And when the cost of goods sold is understated, basically you're saying that you have less expenses than you actually had. Your net income will be overstated. Remember, net income is always the opposite side of expenses, right? Because the more expenses you have, the lower your net income. The less expenses you have, the higher your net income. It makes sense. So in this case, if the cost of goods sold was understated, your expenses were understated, your net income will be overstated. When you have the beginning inventory is overstated, that's the opposite. If it's overstated, your cost of goods sold will also be overstated, which means that your expenses are overstated, your net income will be understated. Now let's look at the second part of it, which is ending inventory. When you have your ending inventory is understated. So ending inventory, okay? Once again, let's take this example here. You had beginning inventory. So this was beginning inventory. That amount is correct. There was no mistake in it. And then we had purchases for 200. Okay? You said that you miscounted. You forgot to include, or you added some goods in transit. You made a mistake with goods in transit. So basically this one was understated. This is where the mistake is. It was understated. Sorry, 200. It was understated by 100. This one is correct. This one is wrong. Now the cost of goods, basically the cost of goods sold, will it be overstated or understated? Sorry? It will be overstated, right? Or is it understated? Think about it. You have your beginning inventory was correct. Okay? Your beginning inventory was correct. Your purchases is correct. So the cost of goods available for sale was correct. You said that you had less inventory. It was understated, so you had less inventory. This is the part. This is the cost of goods available for sale. You said that, how much was it? So it was 600. It's 600. You said that you had, this is what we said here. We said that we had 200. This was 400. What's the real number? Supposed to be 300, 300. Right? That's the number. It's supposed to be 300, 300. When you look at the cost of goods sold, did you overstate it or understate it? You overstated it. Okay? So here, the cost of goods sold will be overstated. When the cost of goods sold is overstated, your expenses are overstated. Your net income will be understated. Okay? You want to think about it this way? Beginning inventory and the cost of goods sold will be in the same direction. Understatement and beginning inventory will lead to an understatement and cost of goods sold. Overstating beginning inventory will overstate cost of goods sold. And then from cost of goods sold to get to net income, you flip them. Okay? You use the opposite term. When it comes to beginning inventory, to ending inventory and cost of goods sold, because they are the opposite side, so they are both together. If one of them increases, the second one will decrease. If one of them is understated, the second will be overstated, because the sum of the two amounts will be the same. Okay? Now there's an important thing here, is that with inventory errors, the mistake will be carried over to the second period, to two periods. Like we said, an error in the ending inventory of 2014 will be carried over to 2015 in the form of, so an understatement. If the ending inventory of 2014 was understated, in 2015, the beginning inventory will be understated, right? So it will be carried over, okay? Because at this time, it will have an opposite effect on net income. Again, the beginning inventory and see here, the effect on net income. Beginning inventory will be the opposite of the ending inventory, for the reason that we mentioned before. Okay? Any questions about this? I know you might think of it as a little bit confusing now. When you read it later on at home, you will find that it is very simple. Now, the effect, the cumulative effect over the 2 years will be 0. Okay? Because an overstatement in net income in year 2014 will be offset by, that if it was understatement, and it will be offset, sorry. It will be basically offset by the second period. Okay? Let's see how. This is, for example, from the first year and the second year. And this example here, this is the incorrect one. So this is the one that is incorrect, and this is the correct one. The cost of goods available will always be the same, no matter what. What we're saying here is that the ending inventory, this is the ending inventory, the count of ending inventory, the incorrect balance was 12,000. So this is the incorrect one. The correct one was 15,000. So was the inventory understated or overstated? Understated, right? You said that your balance was 12,000. In reality, it was 15,000. So it was understated by 15,000. As you can see, this will affect cost of goods sold. An understatement in ending inventory led to an overstatement. So this was understated. This will be overstated. Because cost of goods sold is overstated, net income will be understated. You're saying that you have more expenses. when you carry it over to the next year, this mistake here, this was the ending inventory. It will be the beginning inventory. Now it's the other way around. An understatement. The beginning inventory now is understated. Okay? Once again, you look at the cost of goods sold, it will also be understated. So in this case, your net income will be overstated. Now if you look at the two amounts here, those are the correct ones. And the incorrect ones, the sum of the two will be equal. So the correct one will be 35,000. The incorrect ones will also be 35,000. Which is to mean the effect of inventory error over the 2 years, it will be offset. Okay? It was understated in 2014. It became overstated in 2015. The sum of the two effects will be the same. The balance sheet effect is basically, again, it's carried over from net income to, you end up with the stockholders' equity. So when you have an understatement in the ending inventory, if it's understated, your assets, your total assets will be understated. Liabilities are not affected. What will actually be also understated is the stockholders' equity. One of them is understated, the other side of the equation will also be understated. If it is overstated, the other side of the equation will also be overstated. Okay? So we'll talk about that, about the main part next on Friday.